For nearly a century, the price of gold was decided in two rooms, the LBMA in London and the COMEX in New York. The West set the price, and the rest of the world followed. But in 2024 and 2025, a massive crack appeared in this global monopoly. While gold was trading at one price in the West, it was trading significantly higher on the Shanghai Gold Exchange. At its peak, the Shanghai Premium reached a staggering $13 to $20 per ounce above London prices. This wasn't just a minor glitch. It was a financial declaration of independence. Today, we investigate the moment the Shanghai Gold Exchange forced the COMEX to break its limits, pushing the price of gold into a new, unstoppable reality. Why is gold more expensive in China? It comes down to a fundamental shift in demand. While Western investors were selling gold to chase high interest rates in U.S. banks, the Chinese population was doing the exact opposite. Facing a struggling real estate market and a volatile stock exchange, Chinese citizens turned to gold as the ultimate lifeboat. From gold beans bought by Gen Z to massive central bank purchases by the People's Bank of China, the hunger for physical metal in the East became insatiable. Shanghai isn't just a market anymore. It is the world's largest physical gold hub. Unlike the COMEX, which trades mostly paper contracts, Shanghai is about the physical. If you buy it, you take it, and they are taking it all. When gold is $2,300 in London and $2,313 in Shanghai, a massive opportunity opens up. Arbitrage. Traders realized they could buy gold in the West, ship it to the East, and pocket a guaranteed $13 profit per ounce. This sounds simple, but it created a giant sucking sound in the global gold vaults. Physical gold began flowing out of London and New York vaults and heading east at a record pace. The COMEX, which relies on a small fraction of actual gold to back its massive paper trades, suddenly found its inventories being drained. The West was losing its physical leverage, one bar at a time. The pressure reached a boiling point when the Shanghai price hit a psychological barrier of 100 higher than previous levels. The COMEX could no longer ignore the physical reality. In the world of paper gold, you can print as many contracts as you want, but you cannot print a gold bar. As the physical drainage intensified, the COMEX shorts, mostly big bullion banks, realized they couldn't cover their positions. They were forced to bid the price up frantically to keep up with Shanghai. This forced the COMEX to break through its resistance levels, skyrocketing toward new all-time highs. The tail was no longer wagging the dog. The East was now setting the pace for the West. What we are witnessing is the slow death of paper gold. For decades, the West controlled the price by trading digital contracts that were rarely settled in physical metal. But Shanghai has changed the rules of the game. By demanding physical delivery, they have exposed the emptiness of the Western paper markets. The $13 premium was the first warning shot. It proved that the real price of gold isn't what a screen in New York says. It's what someone is willing to pay to actually hold the metal in their hands. The Shanghai Premium is more than just a number on a spreadsheet. It is a symbol of the shifting centers of global power. Gold is migrating from the West to the East. As China, India, and the BRICS nations accumulate physical metal, the Western financial system is losing its most important anchor. The moment COMEX broke under the pressure of Shanghai was the moment the gold standard quietly moved to the East. We are entering a new era where the price of history's most important asset is no longer decided in dollars, but in the physical hunger of the world's new economic titans.